Hello everyone, Nick Fenton here, founder of TickerTank.com. Today I wanted to talk about slippage, middle price, natural price, and the mid-nat spread. They kind of all coincide together. So I talk about liquidity a lot, and this corresponds with the whole liquidity parameters argument and requirement, more so than an argument. So let's take a look at SPY, which is an extremely liquid options, which has extremely liquid options here. So you can see the current price of SPY is 154.97. The market's closed. It's currently Monday, March 18th at 7 o'clock p.m. Eastern Standard Time. So the market's been closed for a while. If you go to single and we just look at these April, the regulars, not the minis, with 32 days left, we want to look at the closest strike. So closest to the money strike will be 155. Since the current price is 154.97, we're only 3 cents away from that 155 strike. So you can see, if you can look on the put side or the call side, currently we're showing 201 bid and a 206 ask. On the call side, we're looking at 220 bid, 223 ask. Keep in mind the market's closed. Usually we're 1 to 2 cents wide. Over here we're showing 5 cents wide on the put side and 3 cents wide on the call side. So let's say we just wanted to do a bull spread on this particular on SPY. So let's switch this to vertical, and we'll go back to the April 13th. And let's say we wanted to sell the 153, 154. No, let's do the 154, 155. So we want to sell that 31 cents. And what pops up here is, first of all, it shows you the NAT and the mid down here at the bottom. So you can see the NAT, that stands for natural price. Mid stands for middle price. So the closer you are to the natural price, the higher the likelihood of your fill. Here, this is called the mid-nat spread, the difference between the nat and the mid. So the difference between the natural price and the middle price is called the mid-nat spread. In this case, we have a 31 cent natural price, or nat, and we have a 35 cent middle price, or mid. So we have a 4 cent mid-nat spread. It's not bad in the world of options. Basically what that means is you can work this order at 35 cents, which thinkorswim is automatically going to set your limit to 35 cents. They always automatically set at the mid because they want the customer to put the order in at the best potential price. It's going to minimize slippage as much as possible. But in reality, if you really want this to fill quickly, you might want to push it down to, say, 34 or 33. And what you can see happening here is, let's go back to 35. Over here it's saying expected SPY price, 154.83. So you're going to need a 26 cent downside move is required in order to fill at 35 cents. It still may fill at 35 cents, but it's guaranteed to fill if you get a 26 cent downside move. So if you scroll it, push the price down to 34 cents, you can see we need a 13 cent downside move is required in order to get that fill. And if you go down to 33, where you're right in the middle of that mid and that nat, you're right there on the money where it says there's 0 cents required for in downside and SPY for this to fill. So if you put it at 33, if you put the order in at 33, it should fill within seconds. If you work the order in at that mid price 35, it may sit for a few minutes, or it may not fill at all, depending on what the market does. If it continues to move higher from that point, then you may not get a fill, since we're looking at a bull put spread here. Now, if you go all the way down to that 31 cent nat, you can see there's 26 cents to spare. You're definitely filling immediately. As soon as you hit confirm and send, boom, that thing's going to fill. So this is where slippage comes in. There's that 4 cents differential between mid-nat spread. That means there's 4 cents of potential slippage. If you were to put that order in at 31 cents and fill immediately at the nat price, then you would be theoretically giving up 4 cents of potential in this entry, because if you were to work it at that mid, it possibly could fill and you would have 0 slippage. The market is 35 cents right here, so basically 35 cents would be the 0 slippage price point on entry of this spread. 34 cents would have 1 cent slippage, 33 would have 2 cent slippage, 32 would have 3 cent slippage, and 31 would have 4 cent slippage. So in reality, the most slippage you're going to have in this potential case would be 2 cents, because there's no reason that you'd want to work the order at that 31 cent nat, being that there is 26 cents to spare in that case. You might as well, worst case, work it at that 33 where it's right on the money. So, when you enter spreads, you have to decide whether you want to enter the order at the mid, or go between the mid and the nat. Never go at the nat, unless it's a ridiculously illiquid option, which is going to only fill at that nat price, which I would never personally do, because I only use very liquid options. So now we have a good example here in SPY. Let's take a look at Apple, just to kind of give you another idea of a little bit wider situation. So let's delete this here. We want to be looking at the April 13 Apple. Let's go back to singles so we can get a feel for the bid-ask spread. So the last price, 455.72. So the closest to the money strike will be 455. You see here on the put side, we got 14.45 bid, 14.65 ask. So we got about a 20 cent wide bid-ask spread going on there. Change it to vertical, pop those Aprils, and let's just do something similar to what we did there in SPY and do a pretty much right on the money bull put spread. So in this case, we'll be looking at the 450, 455. We'll be selling to open. So let's click on that, on the bid there. And that's going to show us that we have a 230 credit. So the mid in this case, it's automatically putting it on the mid again, which is always going to happen with thinkorswim, like I said. But you can see the nat in this case is 210. So we're talking about a 20 cent mid-ask, or nat mid spread, mid-nat spread. Whereas in SPY, there was only a 4 cent mid-nat spread. So this indicates much more illiquidity. It's still liquid. Apple options are still liquid, but it's a much higher priced stock. Therefore, the derivatives tend to be a little bit wider, regardless of the fact that there's tons of volume and tons of open interest in Apple options. So you've got a lot more potential slippage on entry in this Apple situation. So you can see if you try to work the order at this 230 mid, you're going to be looking at it's telling you that a $1.86 downside move is required in order for this to fill. It may fill right when you put the order in. It kind of depends, but it's pretty doubtful in this situation. Much more likely to fill at the mid price in SPY, since it's such a much tighter mid-nat spread. But when you're looking at this 20 cent mid-nat spread, very unlikely that you're going to fill at that mid price. So let's go down to 225, and you can see there's still 93 cent downside move required showing here in order to get that fill. Probably will fill. It probably will fill in this case. But if you want a guaranteed immediate fill, you don't want to mess around, go to that midpoint right between the nat and the mid, 220. That should fill right away when you hit confirm and send. And of course, if you go all the way down to the nat, it's going to fill in milliseconds, and the market maker is going to be really happy because he just screwed you over. So in this case, you're looking at worst case 10 cent slippage, 10 cent differential between the mid and your zero, pretty much guaranteed immediate fill price point of 220. And you would most likely fill at this 225, but pretty highly unlikely that you'll fill at 230 right away. Now, if you're patient and the market moves to the downside a little bit, of course you're going to get a fill. So if you're bent on that 230 price, there's no harm in putting that limit order in and making it a good for day or good till cancel if you want to work it for a couple days and keep that 230 open in case you catch a downside move early in the morning when you're not watching. So much bigger difference here on the mid-nat. And slippage on entry we've already kind of covered, but the same goes for exit. So when you have these wide mid-nat spreads, you can also get slippage on the exit. So let's just pretend like we want to switch this over to a buy. So let's say we're in the position already, but we want to buy to close it. You can see there's still a 20 cent mid-nat differential. Let's say we filled initially with a 10 cent slippage because we wanted to go ahead and get that immediate fill at 220. Well, in this case, the mid price is 230 and the nat is 250 because we're on the buy side versus the sell side. So you got to pay a little bit more in order to get in that middle point. So if you go to 240, you've got another 10 cents of slippage. So you've got round trip slippage of 20 cents. in this particular example, in the event that you went to the mid price, the price between the mid and the Nat spread, the central price between the mid and the Nat spread. So you had 10 cents of slippage on entry, 10 cents of slippage on exit. That's 20 cents of round trip slippage. That adds up in the long term. So this is exactly why I only trade highly liquid options. I do trade Apple on occasion, but not as often as I trade things like SPY, DIA, IWM, GLD, USO, UNG has pretty liquid options. And there's a plethora of low price stocks out there, JCP, BBRY, to name a few, that have very liquid options and very tight mid Nat spreads that give you worst case 2 to 5 cent round trip slippage versus 20 cent round trip slippage. So that's just something that you should pay attention to. It's not something that's well known, this mid Nat spread. People rarely know what I'm talking about when I speak with members on the phone, and they're very enlightened and appreciative when I explain it to them. So I thought I'd share it with you guys here in YouTube land, and hopefully it helps you out. Have a good evening. Take care, and check out TickerTank.com if you're interested in learning a little bit more about high probability options trading. Thank you.